The U.S. workers' compensation line of coverage remains a key driver of the profitability of the property casualty insurance sector, although economic uncertainty could cause some turbulence for insurers in the near to midterm. Here to discuss a new AM Best report on the line of business are David Blades, Associate Director, Industry Research and Analytics, and Christopher Graham, Senior Industry Analyst. And Chris, starting with you today, workers' comp has been outperforming other PC lines of business for quite a while now. So what's driving that?
We're on like a 30-year run now of a general decline in workforce accidents. And, there's no reason to think that it's going to change right now. I mean, eventually it's got to slow down because you can't have zero workplace accidents. But, it's down 70% according to some government data over the last, over the last 30 years. As long as we're seeing, continued improvements in workplace safety, we're going to see favorable results in workers' comp because each year, even as the pricing is adjusted for what we see, there's still less claim frequency the next year. So continued frequency going down is probably the biggest driver long term. What we've seen over the, probably I say midterm because this has been more the past decade, medical expense payments for the workers' comp losses just haven't been where they were prior to that. There's been a lot of factors keeping medical expenses down, and that's also helping workers' comp be profitable right now.
So despite the favorable loss development, reserves are shrinking. What's going on there?
Well, reserves are shrinking. Also consider net premium was down about 7%. So, you're certainly going to see reserves lower when you have a lower premium base, right? You're not going to need as much reserves for the most recent year if you have less exposure. So we did see the reserves come down, and that's a big part of what's, driving the profits because it takes a while for all these factors, the medical expense payments and the frequency to work its way through the system. And so the claims are reserved, you take the reserves down, and that's, a big part of it. But yes, our reserve, the reserve redundancy is lower this year than it was a year ago. I don't see that as a big problem given that the net premium is down about 7% this year. So I think everything, it's all kind of where you would expect it to be. Eventually, it will hit some equilibrium, but for now, I think, it's still looking good going forward. We still see signs for more continued, workplace safety, especially as you get into AI doing more jobs. That's going to, decrease the workplace accidents. Also, it's going to decrease the premium as well because you're not paying workers' comp insurance on robots and AI tools. But all of that seems to still be pointing towards more favorable development for workers' comp.
David, there have been price decreases every quarter since the end of 2021. How sustainable is that?
So that's something we've been trying to look at very closely, John. When we look at the workers' compensation line from an overall industry perspective, what we've seen is that the profit margin has been shrinking, but the line has still been very, very profitable from that standpoint. And this is from an overall industry perspective. So, I think there is still some room where we're, going to see rates. And again, these things are handled on a state-by-state basis, but, we might still see the overall momentum be downward. What I really think is the key to drill down into is from a company-by-company basis. A lot of companies depend, as the industry does, but a lot of companies depend on their success writing workers' compensation business for their overall book of business to maybe offset tighter profit margins or even losing a little on some other lines of coverage. So as the rates and as pricing continues to soften or continues to be soft, I think it's those individual companies, how they view their overall book of business and the margin they need or they require for their overall profitability. I think, we'll see on a company by company basis them making the determination on where they need to kind of put the brakes on pricing decreases and as that happens throughout the entire industry, I think that's when we'll start to see maybe that momentum quell. But I think right now, at least over the near term, we'll continue to see some downward pressure on the rates and on pricing overall. But I don't think it's going to be for the longer term, like I said, because as the profit margin shrinks, I think companies will see the need, again, to preserve those profit margins, and then how that plays out from an overall industry perspective, is what we'll be focused on.
Given all the economic uncertainty, how do you see 2025 playing out?
So for the workers' compensation line, the macroeconomic pressures have definitely maybe affected other lines of business a little bit more when you think of, lines like commercial auto, private passenger auto, and even homeowners, and, what the possibility is from a tariff perspective in terms of how that impacts claims for those let's say for imported car parts, whether it be for physical damage on commercial auto or private passenger auto. I think some of those macroeconomic pressures have been tougher on other lines of business, but payroll is the main exposure base for workers' comp. So workers' compensation is not alleviate, or they're not alleviated from those kinds of pressures. I think, as we look forward, the pressures we're looking at in terms of what tariffs are going to do from an economic perspective, how immigration policies are affecting labor shortage. We're looking at maybe a cooling job market overall. So some of those pressures and even, some of the recessionary pressures that are aligned with some of those individual macroeconomic pressures, they will put some pressure on the overall workers' compensation business and on payrolls. Obviously, if you look back to what happened in 2020 with COVID, you saw obviously workers' comp be one of the lines that was affected because, again, with less people working, that had a great impact on the overall payroll base. So I think, it is something we'll continue to look at. Workers' compensation is not immune to macroeconomic pressures, but I think from the standpoint of the individual property casualty lines of business, I don't think it's one that's as sensitive to some of those macroeconomic pressures.
Thanks, David. Chris?
Thank you, John.
Thanks, John.
That was David Blades, Associate Director, Industry Research and Analytics, and Christopher Graham, Senior Industry Analyst. You can find the full report online at ambest.com. For AM Best TV, I'm John Weber.